Hi, I'm Hubert Centers. Welcome to Absolute Wealth's weekly edition of Centers Strategies. Let's take a look at this week's strategy. In this week's strategy, let's discuss the importance of having a stop loss or an uncle point, or the amount of money that you're comfortable with losing. Now, first off, if you're trading or investing, surely to God, hopefully you're comfortable with losing some amount of money. You have to have risk capital in order to make any money. I don't know how to make money without risking something, even if it's small. So make sure that you're cool with that. So we're going to change this chart on Eastman Kodak, which is just Kodak. And right now we're looking at a monthly chart just to kind of compound the overall showing of the price action just going south here. So this is a monthly chart, and you can see I've got yellow boxes and I've got purple boxes. Now, basically all that they mean is it's a breakout. So it's based upon an indicator called a Darvas box, and you can read about it in Nicholas Darvas's book, How I Made $2 Million in the Stock Market. And all it's really telling you is on the purple, it means that the low was made first. And I'll use my pen to kind of zoom in here so you can see it. If it's a purple box, the low was made first, and then the high was made first. On the yellow, the high was made first, and then the low was made first. That's okay. That's not the information I really want you to focus on. What I want you to focus on, anytime it breaks the low of the box, that's a short signal. Anytime it breaks the low of the box, that's a short signal. Anytime it breaks the high of the box, which right here, that was an actual long signal, that one didn't work too well. But these two previous more than made up for it. Then you have another sell, you have a buy, sell, sell, buy, sell, and now you can see Eastman Kodak trading at about 59 cents. So try not to get tied up in the story of a company with their technology, because even if they're a big company like Kodak, they can eventually go bankrupt. So let's pretend that you were lucky enough to get long Eastman Kodak at $53, and you rode it all the way up to 80, and you didn't take any profit. Where's your uncle point? Where's your uncle point? Where is it going to be? Is it going to be $44? Is it $39? Is it $29? Is it $5? Is it 58 cents? You have to have an uncle point. So a good rule of thumb that a lot of us professional traders use, not all of us, but quite a few of us, is we will risk 3% to potentially make 5 to 8%. All right. Now you can use a 2-bar trailing stop, you can use a 3% stop loss, and that would be from your entry. So if you were in at 53.93, you'd do a 3%. If it goes more than 3% against you, you'd bounce out of it. You can always get back in. You can always get back in. You can always get back in. And remember this adage: takeoffs are optional, landing is mandatory. So it's just an airplane analogy. Takeoffs are optional, landing is mandatory. And if you're trading without using stops, you're basically on a crash course to failure. So make sure that you always have a protective stop loss to protect your capital from yourself if you are either right or wrong. So now let's take a look at another one that may be on the same path that Eastman Kodak is on. And the company is RIM, obviously. It's trading at about $15.56. My target on RIM right now is going to be south of $5. The technology is out of date. The smartphones is just kicking its butt, and it's just not evolving as fast as it needs to in order to take back a lot of the market share that's been ripped from its hands. So take a look at a potential short on RIM. Now we're looking at a monthly. I think it's going to be trading below $5 in 2012. So let's take a look at a daily chart. So on the daily chart, there's a couple of key areas here, and one key area that we're looking at on RIM is this gap up here. It's an unfilled gap, and they like to fill this gap before it goes lower. That gap may actually never be filled again. So what we're going to do is we're going to draw a fib from this point down to this point and see if we can get a retrace up in this area to actually get a feel for a short. All right. So this is just a little bit longer term play. So we'll go 0.1, 0.2. So if we can get RIM to potentially get up to 1862, that would be a good short area to short it with a stop loss of about $20. So in other words, we're going to risk about 2 points on that trade. Now, if we don't get a retracement up into that area, the very next time that we see a Darvas box sell off or breakdown, in other words, that's a sell signal, this is a sell signal, this is a sell signal, we can also go short with a protective stop loss around 1583. So remember, no matter what you're trading, how long you're holding it, make sure that you have a protective stop loss and don't get married to the position. Good luck. Hope it helps. See you next week.